Something unprecedented just happened in the gold market. And if you're not paying attention, you're about to miss one of the most significant shifts in financial markets we've seen in decades. For years, gold and stocks moved together. When the S&P went up, gold went up. When stocks fell, gold fell with them. That correlation became so reliable that traders built entire strategies around it. Central banks factored it into their models. Financial advisors used it to construct portfolios. But that relationship just broke, and the implications are staggering. Let me show you what's happening right now, because the data tells a story that most people aren't seeing yet. Gold recently hit record highs above $4,000 per ounce. At the same time, stock markets have been volatile, uncertain, caught in a tug-of-war between economic data and policy decisions. And here's the thing that should make you sit up and pay attention. Gold is rising regardless of what stocks do. This isn't normal. This is a fundamental shift in how gold behaves as an asset, and it signals something much bigger than just a price move. Think about what correlation means in financial markets. When two assets move together, they're responding to the same forces. When gold and stocks both rose, it meant they were both reacting to the same thing: liquidity, monetary policy, risk appetite. Investors felt confident, so they bought everything. When fear hit, they sold everything. But when that correlation breaks, when one asset starts moving independently, it means something new is driving it. A force that doesn't care about the old rules. A demand that's coming from somewhere else entirely. And that's exactly what we're seeing with gold right now. Central banks are buying gold at a pace we haven't witnessed in over half a century. In the third quarter alone, central banks purchased 220 tons of gold. That's a 28% increase from the previous quarter. These aren't small players making speculative bets. These are the institutions that manage trillions in reserves, that set monetary policy for entire nations, that have access to information and analysis most of us will never see. And they're accumulating gold like their survival depends on it. Let me put that in perspective. For decades, central banks were net sellers of gold. They believed the dollar was the ultimate reserve asset. They thought gold was a relic, a barbarous remnant of an outdated monetary system. Countries like the UK famously sold half their gold reserves at the bottom of the market, locking in losses that still sting today. But something changed. Starting in the late 2000s, central banks became net buyers, and that buying has accelerated dramatically in recent years. We're now seeing 3 consecutive years of purchases exceeding 1,000 tons annually. That's not a trend. That's a structural shift. Why? What do they know that the average investor doesn't? They're watching the same thing you are. A global monetary system under stress. They're seeing record debt levels that can never be repaid in real terms. They're watching currency wars play out in real time. They're observing the weaponization of the dollar through sanctions and financial restrictions. And they're making a calculated decision. Diversify away from dollar dependence. This is what's called de-dollarization. And it's not a conspiracy theory. It's official policy for major economies around the world. The BRICS nations have been explicit about their intentions to reduce dollar reliance. They're settling trade in local currencies. They're building alternative payment systems. And they're backing those systems with the one asset that every country recognizes as valuable: gold. China has been particularly aggressive. Their official reserves show steady gold accumulation, but many analysts believe the real numbers are much higher. Why would they hide it? Because if the market knew the full extent of their buying, gold prices would spike before they finished accumulating. It's the same strategy any large buyer uses: accumulate quietly, reveal later. Russia took it even further. After facing sanctions, they dramatically increased their gold reserves and reduced dollar holdings. They learned a hard lesson. Assets held in another country's currency can be frozen, seized, or devalued at will. Gold held in your own vaults cannot. This isn't just about geopolitics, though. There's a deeper financial logic at work. Gold has always been the ultimate form of money because it has no counterparty risk. When you hold physical gold, you're not depending on anyone else's promise. You're not exposed to a government's fiscal discipline or a central bank's monetary policy. You're holding an asset that has maintained value for thousands of years, through every empire's rise and fall, through every currency's creation and collapse. And right now, as debt levels reach unprecedented heights and central banks navigate between inflation and recession, that quality matters more than ever. Here's something most people don't understand about the current financial system. It's built on confidence. Confidence that governments will repay their debts. Confidence that central banks will maintain currency stability. confidence that the banking system is sound. When that confidence erodes, everything changes. We saw glimpses of this during the banking crisis earlier this year, when regional banks started failing, when depositors questioned whether their money was safe. Gold spiked. Not because of inflation, not because of interest rates, because of fear that the system itself might be fragile. That fear hasn't gone away. It's just been papered over with more liquidity, more guarantees, more intervention. But the underlying problems remain. Too much debt, too little growth, too many promises that can't all be kept. And smart money is positioning for what comes next. Look at what's happening in the physical gold market. Premiums for physical bars and coins have been elevated for months. That means demand for actual metal exceeds what's available at current prices. Refineries are running at capacity. Mints can't keep up with orders. This is real demand from real buyers who want to hold the actual asset, not a paper claim on it. This brings us to one of the most important dynamics in the gold market, the difference between paper gold and physical gold. Most gold trading happens on exchanges like the COMEX, where contracts represent claims on gold, but very little physical metal actually changes hands. It's a fractional reserve system, similar to banking. For every ounce of physical gold in the vaults, there are multiple paper claims against it. This works fine as long as everyone doesn't demand delivery at once. But what happens when they do? We've seen stress in this system before. During the pandemic, when physical gold became hard to source, the spread between paper prices and physical prices widened dramatically. Buyers were paying significant premiums over the spot price just to get actual metal. The system was revealing its fragility. Now imagine that dynamic playing out on a larger scale. Imagine central banks, institutional investors, and wealthy individuals all deciding they want physical gold, not paper promises. Imagine the scramble for actual metal when the market realizes there isn't enough to satisfy all the claims. That's the setup we're looking at right now, and it's why gold's decoupling from stocks matters so much. When gold moved with stocks, it was trading as a risk asset, responding to the same liquidity flows that drove equity markets. But when gold moves independently, especially when it rises while stocks struggle, it's trading as what it truly is: a monetary asset, a store of value, a hedge against systemic risk. This shift tells us that a different type of buyer is entering the market, not speculators chasing momentum, not hedge funds making tactical bets, but long-term holders who understand what's coming and want to be positioned before everyone else figures it out. Let me share something that might be relevant to your situation. If you're sitting on a significant retirement account, say $100,000 or more, there's a way to get physical gold into that account without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works. You'll find it in the description below. It covers the mechanics, the rules, the things to watch out for. Worth checking out if you're thinking about adding gold to your retirement strategy. Now back to what's driving this market transformation. Interest rates play a crucial role in gold's behavior, but not in the way most people think. The conventional wisdom says gold struggles when rates rise because it doesn't pay interest. Why hold gold when you can earn 5% in treasury bills? But that logic only works if you trust that the 5% you're earning will maintain its purchasing power. If inflation runs higher than your interest rate, you're losing money in real terms. And if you're worried about the long-term stability of the currency itself, that interest rate becomes meaningless. This is why gold has been rising even as rates remained elevated. The market is looking past the nominal rate and focusing on the real rate, adjusted for inflation. And more importantly, it's questioning whether those rates can be maintained without breaking something in the financial system. Think about the math. Government debt has exploded. Every percentage point increase in interest rates means hundreds of billions more in annual interest payments. At some point, those payments become unsustainable. The government faces a choice: default, which is unthinkable, or inflate, which is inevitable. Gold is pricing in that inevitability. History gives us a roadmap for what happens next. In the 1970s, gold went from $35 to over $800 as inflation raged and confidence in the dollar collapsed. That wasn't a smooth ride. It was volatile, with sharp corrections along the way, but the overall trajectory was clear. Gold was repricing against a currency being debased. We saw another surge in the late 2000s as the financial crisis revealed the fragility of the banking system and central banks responded with unprecedented money printing. Gold went from around $700 to over $1,900 in just a few years. Each time, gold was responding to the same fundamental driver, loss of confidence in the monetary system. And each time, the people who positioned early, who understood what was happening before it became obvious, were the ones who benefited most. Right now, we're in the early stages of a similar move. Gold has broken out to new highs, but most investors haven't noticed yet. They're still focused on stocks, on tech, on the latest AI hype. They're not paying attention to what central banks are doing, to what the physical market is telling us, to what the breakdown in correlation means. But they will. And when they do, when the mainstream finally catches on, that's when gold really moves. Let me explain the mechanics of how this plays out. Right now, gold ownership among investors is relatively low. Most portfolios have little to no gold exposure. Financial advisors typically recommend 2 to 5% allocations, if they recommend gold at all. Institutional investors have even less. But what happens when that changes? What happens when the narrative shifts from gold is a barbarous relic to gold is essential portfolio insurance? What happens when institutions decide they need 5%, 10%, 15% exposure? The math is staggering. There's only so much gold in the world. Annual mine production is around 3,000 tons. That sounds like a lot until you realize that's only about $200 billion worth at current prices. Compare that to global financial assets measured in the hundreds of trillions. If even a small percentage of that capital tries to move into gold, there simply isn't enough supply to meet demand at current prices. Prices have to rise, potentially dramatically, to ration the available supply. This is what's called a supply-demand imbalance, and it's the setup for explosive price moves. We're already seeing signs of this dynamic. Exchange-traded funds backed by physical gold have seen renewed inflows after a period of outflows. That means investors are coming back to gold, adding it to portfolios, recognizing its value in the current environment. But ETF flows are just one piece of the puzzle. The real story is in the physical market, where central banks and high-net-worth individuals are accumulating quietly, away from public view. These buyers aren't trading. They're not trying to time the market or catch short-term moves. They're building positions they intend to hold for years, possibly decades. They're treating gold as insurance, as a permanent allocation, as a core holding in a diversified portfolio. And that type of buying creates a floor under the market. It means that dips get bought, that supply gets absorbed, that the path of least resistance is higher. Now, let's talk about what this means for the stock market relationship. For years, the correlation between gold and stocks was positive. They moved together because they were both responding to the same monetary conditions. Easy money lifted all assets. Tight money pressured everything. But that correlation was never stable over longer time periods. If you look at historical data going back decades, you'll see that gold and stocks have had periods of positive correlation and periods of negative correlation. The relationship changes based on what's driving markets at any given time. During periods of economic growth and stability, they tend to move together. Both benefit from confidence and prosperity. But during periods of crisis, inflation, or monetary instability, they diverge. Stocks struggle while gold thrives. We're transitioning from the first regime to the second, and that transition is what's causing the decoupling we're seeing now. This has profound implications for portfolio construction. The whole point of diversification is to hold assets that don't all move together. If everything in your portfolio rises and falls in sync, you're not diversified. You're just exposed to the same risk in different forms. Gold's value as a portfolio holding comes from its tendency to perform well when other assets struggle. It's the ultimate diversifier, the asset that zigs when everything else zags. But that only works if gold actually behaves differently from stocks. For the past few years, that diversification benefit was muted because gold and stocks moved together. But now, as the correlation breaks down, gold is reclaiming its traditional role. It's becoming the hedge it's supposed to be. This is why sophisticated investors, the ones managing billions in assets, are increasing gold allocations. They're not chasing performance. They're not speculating on price moves. They're recognizing that the environment has changed and portfolios need to adapt. Let me paint a picture of what the next few years might look like. We're in a world of elevated debt, aging demographics, geopolitical tension, and monetary experimentation. Central banks are trapped between inflation and recession, unable to normalize policy without triggering a crisis. In this environment, gold becomes increasingly attractive. It's the asset that doesn't depend on economic growth. It doesn't require corporate profits or productivity gains. It simply needs to maintain its role as a store of value, a role it's played for thousands of years. As more investors recognize this, as the narrative shifts, as allocation decisions change, gold moves higher. Not in a straight line. There will be corrections, periods of consolidation, moments of doubt. But the overall trend is clear. And here's the thing that most people miss. The biggest gains in gold don't come from the steady grind higher. They come from the moments of crisis, when fear spikes and everyone rushes for safety at once. Those are the times when gold can move 10, 20, 30% in a matter of weeks. We saw this during the financial crisis. We saw it during the pandemic. We'll see it again the next time the system faces stress. And make no mistake, that stress is coming. The debt levels are too high. The imbalances are too large. The political divisions are too deep. Something will break. The only question is when and what form it takes. Gold is insurance against that moment. It's the asset you hope you never need but are grateful to have when crisis hits. Now, let's address the skeptics. There are always people who dismiss gold, who call it a pet rock, who argue it has no intrinsic value. They point out that gold doesn't generate cash flow, doesn't pay dividends, doesn't grow earnings. And they're right about all of that. Gold isn't a productive asset. It's a monetary asset. It's not supposed to generate returns through growth. It's supposed to preserve wealth through time. The question isn't whether gold is better than stocks in a growing economy. Of course it's not. Stocks represent ownership in productive enterprises that create value. In a healthy, growing economy, stocks will outperform gold over long periods. But we're not always in a healthy, growing economy. Sometimes we're in periods of crisis, inflation, or monetary chaos. And in those periods, gold dramatically outperforms stocks. The goal isn't to choose between gold and stocks. It's to hold both, in proportions that make sense for your situation and outlook. It's to recognize that different assets serve different purposes in a portfolio. Gold's purpose is protection. It's the fire insurance on your financial house. You don't buy fire insurance hoping your house burns down. You buy it so you can sleep at night knowing you're protected if disaster strikes. Right now, the risk of financial fire is higher than most people realize. The fuel has been building for years. Excessive debt, monetary distortion, asset bubbles, geopolitical tension. All it takes is a spark. And when that spark comes, when the fire starts, gold is what protects your wealth from being consumed. Let me share one more historical parallel that's particularly relevant right now. In 1971, President Nixon closed the gold window, ending the dollar's convertibility to gold. That decision fundamentally changed the monetary system, removing the last constraint on money creation. What followed was a decade of inflation, currency instability, and gold's rise from $35 to over $800. The people who understood what was happening, who positioned in gold early, preserved and grew their wealth while others saw their purchasing power eroded. We're in a similar moment now. The constraints on money creation are gone. Central banks can create unlimited currency with a keystroke. The only limit is political will and inflation tolerance. And we've seen that when crisis hits, both of those limits disappear. The pandemic response proved this. Trillions in new currency created in months. Deficits that would have been unthinkable just years before. And the promise of more whenever needed. That's the environment we're operating in. That's the backdrop against which gold is repricing. And that's why the decoupling from stocks matters so much. Gold is no longer trading as a risk asset, responding to the same forces that drive stocks. It's trading as a monetary asset, responding to concerns about currency stability, debt sustainability, and systemic risk. This is the new era the title refers to, an era where gold reclaims its traditional role, where it becomes essential rather than optional, where it moves independently, driven by its own dynamics rather than following stocks. The implications extend beyond just gold prices. This shift tells us something about the broader financial system. It tells us that confidence is eroding, that the old certainties are being questioned, that smart money is positioning for a different future than the one most people expect. And here's what you need to understand. By the time this becomes obvious to everyone, by the time it's being discussed on mainstream financial news, by the time your neighbor is talking about buying gold, the easy gains will be gone. The opportunity is now, while most investors are still focused elsewhere, while gold is still underowned, while the decoupling is just beginning to be recognized. This isn't about timing a trade. It's not about trying to catch the exact bottom or sell the exact top. It's about recognizing a fundamental shift in market dynamics and positioning accordingly. The central banks figured this out years ago. That's why they've been accumulating steadily, building positions while prices were lower, preparing for what they see coming. The institutional investors are figuring it out now. That's why we're seeing renewed interest, increased allocations, strategic positioning. The question is, when will you figure it out? Will you be early, positioning before the crowd? Or will you wait until it's obvious, until everyone else has already moved, until prices have already adjusted to reflect the new reality? The choice is yours. But understand that this moment, this decoupling, this shift in gold's behavior, is telling you something important. It's telling you that the rules are changing, that the old relationships are breaking down, that a new era is beginning. And in this new era, gold isn't just another asset in your portfolio. It's the foundation. It's the anchor. It's the protection against everything else going wrong. The stock market might recover. Bonds might stabilize. Real estate might hold value. But gold will be there regardless, maintaining its purchasing power, preserving your wealth, providing the insurance you need in an uncertain world. That's what makes this moment so significant. We're not just seeing a price move. We're seeing a fundamental shift in how gold behaves, what it represents, and why it matters. The decoupling from stocks is just the beginning. What comes next is gold reasserting itself as the ultimate form of money, the asset that survives when everything else fails, the wealth preservation tool that has worked for thousands of years and will continue working for thousands more. Pay attention to what's happening. Watch the central banks. Follow the physical market. Understand the dynamics. And position yourself accordingly. Because this new era in gold is just getting started. And the opportunities it presents won't last forever.